Hi guys, welcome back to Trademanza's weekly educational video where we bring to you interesting things about the stock market such as the business models of different companies listed in the Indian stock market or how to do trend analysis so that you can profit in bull and bear markets both. These videos are usually supposed to go out on Sunday, but as you can tell from my voice, I was a little bit sick and I still am. I have a little bit of a cold, but I couldn't let you guys miss out on a week's worth of content. So I thought why not release last week's video on this Friday instead. So today I'm going to tell you some important things, like very important tips about support and resistance and what to do close to them, and also some important things about moving averages. I'm going to be referring to a few things which were discussed in our last week's video, which was the one about how to trade breakouts. So do go watch that video if you haven't watched it yet. And before we get started with this video, don't forget to subscribe to our channel, like our videos and switch on notifications. Now let's get started. If you saw last week's video, you would remember that this region here, let me highlight it. This region here is what we would call a confluence zone, right? As we can see, the market twice or thrice it has tried to take support at this region, and then once that support was broken, perfectly like we said in the previous video, it is now using that level as resistance, right? So when a support is broken, it should act like resistance, and when a resistance is broken, it should act like support. So now what important thing I want to tell you here is, let me get rid of this confluence zone, is usually when you would see a support, you would want to go long at that support, right? Like, let me give you an idea of another one. Here, if I see, this can be taken as a support for this stock, right? We can say this region is the demand region where there are buyers waiting to push the price up further. We call it the demand region because this is where the buyers take control and push the stock upwards. Whereas this can be called as the supply zone. Supply zone means, there's a lot of, in simple words, there's a lot of supply of the stock over there. That is, the sellers take pressure over there and they're ready to push the price down. Now, one thing you notice about this, okay, just let me refresh this chart here. Really sorry about that. Yeah, let's zoom out. Now, one thing you notice about this chart is that, before that, let me just plot these again. So we have this, which was the demand zone like we discussed in the video, and this being the supply zone like we discussed in the video, right? So one thing you would see here is that after the stock gave a really good up move and a breakout, one interesting thing to see is that in every swing, right, the stock is making lower highs, right? Like as we can see here, first, this could actually be taken as the first support zone, am I right? So what we see here is that the stock consolidates here, then breaks out, then it comes back here, it takes support here again. But then when it goes up, it reverses from a slightly lower level, right? And then again takes support here, and then it reverses from a lower level again. So what you want to take away from this is that it is better not to go long at support levels when a stock has continuously been making lower highs. What I mean by that is when a stock goes up and then comes back down to a support level, you want that support level to somewhat be higher than the previous support level. You want it to be a higher swing. So it's better not to go long in a stock which is making continuously lower highs. That was made visible here. It made a lower high here. Then again, it made a lower high here. And then that support level was broken out. And then the same thing is visible even here. The stock takes support here. It goes up, comes down. It goes back up again. It goes here, takes support. And now it's reversed from a slightly lower level, right? So once you see the stock come back here, do you think just because it's a support you should go long? No, right? Because the stock has been making lower highs, it indicates that the sellers are somewhat in control. And if we look at the big picture of this chart as well for a very long period of time, whether we look at this or this or this or this, the stock has continuously been making lower highs, indicating that sellers are somewhat in control. So what you want to take away from this is that you should not be going long at support levels if the stock has been making continuously lower highs, right? Now, this thing is quite annoying. Let me refresh this too. So now I want to show you one other thing about moving averages, right? We know what moving averages are, how you can use moving averages when you want to incorporate a trend following strategy. But there are also times when moving averages are not going to be very helpful. So I want to show you what exactly the situation could be like when moving averages are not helpful. And this was the example I picked out for that. Okay. So if we look at this chart here, right? This chart here, we can see that this is the support zone, right? This is the demand zone and this is the supply zone of the stock. This is where the sellers come into play and this is where the buyers come into play. Now I'm going to go here and add the moving averages. Let me add the moving average. Usually most people prefer using two moving averages. So I'm going to use the most favorite, which we have already discussed in videos. If anything you feel like you're missing out on, you need to go and check out our previous videos, because that is where we have discussed all these things. Let me make the 50-day moving average purple in color so that you can see the difference between both of them clearly. Yeah. So now you would see what happens here is, usually how we use moving averages is that we try to look at how a stock is reacting once it has some sort of interaction with the moving average, right? If it touches the moving average and it starts going down, that is the sign of a downtrend. So we would go short on the stock. Similarly, if it touches the moving average and it starts going up, that is a sign of a long trend and we go long in the stock. But what happens when the stock is not continuously making higher highs and higher lows like it would in an uptrend? Look at this example. Here what happens is that when the stock is stuck in a range, the moving average is actually just noise. So what you want to take away from this is that when the market is stuck in a range, there's no point using moving averages. What's going to happen is that the stock is just going to slice through the price. You're not going to get any important interaction at the moving average. Here, let's suppose we see one green candle being formed at the moving average, but it just goes and falls through it, right? And when it falls through it, what you would see is that it's taking resistance, right? There are a few red candles over here. So maybe I can go short. But as soon as it goes right here, it starts going back up again. So you don't really have any proper, levels with which you can use the moving average. So in markets like this, it's better to just use simple support and resistance along with maybe some other indicators. In the coming few weeks, we are going to be teaching you other indicators such as RSI, MACD, and how you can use those. For now, we've just been talking about very basic things such as price action and moving averages, right? And now one other important thing which I want to discuss is that there is no such thing as the perfect moving average, right? Like you would probably be on YouTube watching so many videos about how the 50-day moving average is the best, or the 22-day moving average is the best, or 200-day moving average is the best. Some people tell you for intraday you should be using like the 5-day average or 12-day average. Well, the thing is, what moving average you want to use depends upon what sort of strategy you have and also upon what sort of time frame you're using. So what I'm going to show you here is I'm going to again add two moving averages, okay? As usual, the 20 and 50. These are my personal favorite. I'm not saying you have to use the same. You could like the 200 or you could like the 12-day moving average or anything. So let me change again 9 to 22. And let me make the other one a 50-day moving average, right? And oh yeah, I have to change the color as well. And I've made the color purple, okay? Yeah. So now we are looking at the chart in a 5-minute time frame, right? What's interesting to see here is that the more important, the more important zone with which it interacts a lot is the 50-day moving average, which is the pink line here, right? Like if we look, it comes near the 50-day moving average here. It takes resistance over there, falls down. It goes back up. It takes resistance there again, falls down. Again, it goes all the way back up to the 50-day moving average and falls from there. So in this scenario, you would think that the 50-day moving average is the best. However, if I am to change time frame, and let's suppose this is the same chart, I'm just going from 15-minute candles to 5-minute candles, right? Sorry, the other way around. Now, if you look at the 15-minute candles, you would see that surprisingly now the 50-day moving average is actually really far. The stock is continuously interacting with the the blue line, which is the 22-day moving average, right? So if you're someone who likes trading on a 5-minute time frame, maybe you will prefer the 50-day moving average. If you're someone who likes to trade with a 15-minute time frame, you will maybe prefer trading with a 22-day moving average. So the takeaway from here is that there is no such thing as like the best moving average. Which moving average you use is going to depend upon your strategy and what your preferences are. So guys, that's it for this week's video. So the important things we discussed today is that you don't want to be going long at a support when the stock is continuously coming back from lower highs. The second thing we discussed is that moving averages are actually helpful only in trending markets. What is a trending market? A trending market is when there's a continuous higher high and a higher low, or the other way around, which would be a downtrend. However, when the markets are sideways, moving average is not really helpful, and maybe in that time frame you could remove your moving average. And the final thing we discussed is that there is no such thing as the perfect moving average. So you can stop going around on YouTube searching for what the best moving average is. Whichever moving average you want to use will always depend upon the time frame with which you trade and what sort of strategy you have. Now guys, subscribe to our channel, switch on notifications, do like our videos, because this Sunday finally we're going to be getting started with indicators. I have lots of important indicators which I want to bring to you, such as the RSI, the MACD, and many more. Thank you.